folks. Liz just made an excellent suggestion. Everybody turn off your phones. And if you turn them to vibrate, don't let them stay on the table because it's like a sounding board. If you put them on the plastic, it's a little bit better.
Includes me too.
It's really embarrassing when the speaker's phone rings.
It's really bad when I answer.
Don't do that. So everybody, we have Dan Saccani today. He is the founder and CEO of Ravix Group, and he's going to talk about bootstrapping and fundraising. Everything okay there, Ricky? Yes. Okay. All right. Well then, without further ado, feel free to get up and get more food as you need it. And Dan will have some really interesting things to say about bootstrapping and fundraising.
Ask questions.
Throughout? Sure.
Yeah, so I guess the pressure's on. It's the first time anybody's actually ever paid to see me talk. So I guess I'll be a little nervous. I figured half the money went to lunch. So I'm the president of Ravix Group. I did my first startup in 1983. That company was founded by the people here that might remember what a PBX is. There we go. There's one guy that knows what a PBX is. Okay. But anyway, the guy that invented the PBX started another company in '82 and it was called the least cost routing machine. For those of you that remember MCI, this was an add-on box that you plugged into your PBX and it figured out which was the cheapest phone line to use. We started there. That was pretty much a bust. We converted the company about a year and a half after I got there to the same guy invented voicemail and the automated attendant. So I've seen a few new technologies from their start, and that was the first one. So we had the, again, for those of you that remember calling the time lady, we actually hired the time lady to come in and record our prompts. So it was pretty interesting. It's like, that's the lady, wow. So there was a lady behind the time voice, and I met her. So anyway, I've been doing startups for quite a while. I've seen good things, bad things. I've seen bad things turn into good things, and I've seen good things turn into bad things. One of the first rules I learned about startups is if you see a startup and all the founders have pictures of Porsches and Ferraris on the wall because they're going to buy them when they're successful, they won't be successful. The guys that show up with a beat up outhouse somewhere that are just barely scraping along, typically those guys end up being the successful guys. So there are not a lot of rules. I'll try and give you some general idea and directions of where to go, but it's kind of wide open. So we'll start with what is lean and mean. Back to the Porsches and Ferraris. Don't be too optimistic. Figure out, kind of what you're trying to do and stay focused. So I got a couple things here. Lean is focus on what you really need to do to get a job done. Don't try and boil the ocean. Just figure out one small thing that you can be successful at and do that well. You can boil the ocean later. Milestones, figure out what matters. Set a milestone that will convince an investor that, one, you know what you're doing, and two, you can actually get something done. Because if you don't have any milestones and you're going to go from an idea to $100 million in customers, nobody's going to believe you. So set up something where people can see you actually are achieving something. Act like it's your last dollar, because it may very well be your last dollar. Yeah?
Back to milestones, would you say, would you target like a gross revenue number, or would you target like a cash flow positive? What's a good milestone to kind of?
Both, well, for an early stage company, both of those are way too advanced. A good milestone might be one customer who verifies that you have a good product. And obviously, the bigger the customer, the better. But that's something that's achievable in a, well, depending on what your product is, in a relatively short period of time. And the milestone may just be to prove that your concept works. So have, different milestones, but keep them reasonable. Because everybody, at least in the venture world, nobody's going to touch you unless you're, $1 billion market. But nobody, you walk in and say it's $1 billion market, they'll go, great, but what are you going to do to get there, which is the most important part. Let's see. So act like it's your last dollar, because it probably is, unless you get lucky. And the last one's kind of interesting. I tell CEOs this all the time. CEOs, in my world, we have a lot of SaaS companies, internet companies, things like that. And they always worry about revenue that goes on your income statement. And in an early stage, nobody cares about, quote, revenue. The accounting gods will tell you what revenue is. What your investors care about is somebody writing you a check. So whatever your product is, if you think you sold your product because some guy installed it and it's running and it's working, but he hadn't paid you, probably haven't done anything. So the key to all of this is get some money, because that's what an investor is going to be looking for. Somebody will pay you money for something, you probably created something with some value. So what to keep and what not to keep. Now I kind of put myself in the first category here. So anything that can get you to the next major milestone, you don't need. That you can put on the back burner. You can do that next month. Stay focused on the milestones. Then the other one, where I put myself on the chopping block, because we have companies all the time call up, hey, we're a startup, we need our financials done. No, you don't. You need a checkbook. Know where your money is. We can guarantee you we can create your financials later. You just want to be able to show somebody you collected some money. So then we'll go over the don't cuts, which is keep track of your cash. We're going to talk about legal stuff a little bit later, but make sure you have good professional advice. We'll talk about it later, but I'll bring it up now. Just a lot of times I'll see guys that get incorporated, and the first question I ask is, who are your attorneys? Well, my brother-in-law had a roommate in college in Des Moines, and he's doing my incorporation. Doesn't work. You need to get, especially if you're going to go for venture money, you need to get a lawyer that knows the venture market. They're going to be probably the best source of funding you can find. So, you can call up Wilson Sonsini and Cooley and Oric and all those people. And they have, the guys that work in Silicon Valley, if you're looking for venture money, are going to know who the venture guys are that are in your market and how they operate. And you can get, most of those attorneys work for free until you get funded. So they're big law firms, they're going to cost you a ton of money at some point, but they know early on to not going to charge you. So, and then tax advice, same thing, legal, don't get into trouble. HR is a big issue. We run into this all the time where people, well, I'm paying a guy's stock, or I'm, paying for his hotel room or some goofy thing. And it's like, well, it's okay, but at some point it's going to cost you. So make sure you have advice and you know where the risk is. And probably the best thing about professional advice is you want to make sure that you know what's at risk. Because a lot of startups, you're not going to pay people. You're going to do things that are, out of the ordinary. And that's fine as long as you know what the exposure is to you in the long run. And one other little tip that I give CEOs all the time is you are personally liable for payroll taxes. So you can, part of my practice is a bankruptcy practice, so you kind of do this occasionally. You can not pay your vendors. There's all sorts of things you cannot pay. But if you don't pay your payroll taxes, you're going to jail. Well, you don't go to jail, but I've actually repoed somebody's house, so it gets pretty ugly. So make sure you understand risk, especially when it comes to HR, human resource, payroll, things like that. Just know what your exposure is going to be. Payroll service, that's kind of tied in. Make sure you do that right, you pay people correctly. And then investment infrastructure that scales. And that gets back to your lawyers. Make sure you put together a program. Again, I'm doing this from a venture standpoint, but venture capitalists won't invest in LLCs or LLPs or sub-S corporations and things like that. If you're going to get venture money, it's going to have to be a C Corp. And that just has to do with all the laws, their investment laws and things like that. So you want to make sure you're set up, because we get a lot of people, well, I have an LLC that I set up in Montana. It's like, okay, when are you going to convert? Well, what do you mean? Well, you got to be a corporation. So pay attention to those things. Cut the other stuff. Let's see, time's money, everybody's heard that. You know, this one's probably pretty obvious to everybody. But in today's world, you can outsource just about everything. So HR, finance, payroll, insurance, all that stuff. It's usually a little less expensive to do that in the early stages. Later on, it's going to start costing you money, but at least you can find inexpensive sources that know what they're doing. Rent instead of buying. And that goes for consultants. Again, consultants on the payroll side get a little dicey, but you know, there's lots of ways to get free advice. Use it as much as you can. One little hint on free advice is make sure that you have confidentiality agreements, non-competes, all that stuff with consultants. I've had deals. I had a deal one time we were raising, I think we raised like 30 million bucks. And they had a guy who did the logo for the company, didn't sign a confidentiality agreement. The investors wanted everybody to sign one. We had to write the guy, it was like a $15,000 or $20,000 check just to sign the confidentiality agreement, because he never did it. He designed the logo. It wasn't like he knew the secret sauce, but investors will want those things signed. So when you work with your lawyers, make sure you get, you know, confidentiality, non-competes, whatever. Non-competes are usually kind of air, but get all that stuff taken care of through your attorneys. Make sure you do it up front. And even if a guy's a consultant, you got to get them to sign that stuff, because it will goof up your funding rounds when you get down the road. So use those things to save time. And what I tell people all the time, and why we're in business, is I wouldn't be here if having a good finance guy meant you could raise money. I've been gone a long time ago. But the fact of the matter is, when you raise money, they care about the management team and the CEO and the technology. They don't care about finance. They don't care about HR. But they want, and you need to spend your time on the product and sales and things like that that will create the money. I've had multiple CEOs spend time in finance and HR, and finally I just tell them, look, you know, why are you wasting your time over here? The money's over there. They want to know you know what you're doing. They don't really care about the finance stuff. That's not the value add. The value add is your product and things like that. So focus on what creates value, not on, unfortunately, the stuff I do. All right, the business model. And again, some of these apply to everybody, some do, some don't. So we'll just go through them. Customer acquisition cost is always a big question, especially if you're a software company or a medical device company. But in general, any company, how much advertising? What do you have to do to actually get a customer? How much is that going to cost you, and is that scalable? So think about that. Unit cost is whatever you're selling, what's it cost you? Pretty straightforward there. Cost onboard. So you've identified a stack of customers, you get 100 customer leads or whatever. What's it actually take to bring them on board and get them up and running? Some of that stuff can be as easy as you ship them your product. Software company, it could be, months and months of installation. So think about that, because that's got to be thought through in your business model. You got a question of support, same thing. Working capital, that gets a little dicier. Again, if you go back to milestones, what we tell people when they do a cash plan is line up your milestones and then line up your cash. And your cash better run out about 4 months after you hit a major milestone. Because once you hit the milestone, then the investors will believe you and then they'll invest. But if you run out of cash a month before a milestone, investors are going to sit there, say, okay, well, let's wait a month and see if you can get to that milestone. So do a timeline of your product, your milestones, your development milestones, and then lay your cash in. And make sure that your cash always lasts longer than the milestones. Because investors have, no qualms about telling you, well, work on it, don't get paid anything, and let us know how it goes. We'll be waiting here in a month when you figure it out. And that's the cash flow and the burn. So kind of figure those things out. When we do pretty elaborate financial models, and one of the things that we tell people all the time is, look, the model's not right. We know that. But what investors want to see is that you thought through every little variable that could affect your business. And not that you got the variable right, it's more that you at least thought about it and it's on your radar screen. So, if you go back to whatever your business is, think of the things that can go wrong. Think of things like, well, will my price stay the same? Don't have a 5-year plan where you're selling a widget for $1 today and you're selling it for $1 a year from now, because we all know prices drop. So think through that, and at least put something in the model and say, well, we'll drop 5-10% a year. And as long as you have that variable there and investors know that it's on your radar screen, they're going to be happy. It's like, okay, at least these people know about it, so that if something changes, we can course correct. One of the most successful investors I worked with, because I worked for the companies, but he was a guy, he was in Microsoft, and a few other early stage companies. And he always said, look, I never had a successful company that didn't almost fail at least once. And the idea there is, you may go in today thinking your product's going to be blue, but by the time you end up bringing it to market, it may be red. And his point was, you have to change. Stuff's going to happen. So be flexible and be ready to make changes, and don't get buried. Don't put your head in the sand thinking it's got to be blue because I like blue. It may not be blue, and that's okay as long as it works. All right, let's see. So again, it kind of goes back to your question on milestones. So Fundraising, so early stage, you kind of got an idea, you kind of got a core team. You know, in today's world, that's kind of seed, angel funding. Most of those companies aren't looking for any revenue, or the investors aren't looking for revenue. They're just looking for validation of the concept, validation that you can get somewhere. Go to market seed, you build up a team, and you're starting to build up your channels, and you can see where you're going. This is kind of where you have, say, I don't know, one customer, two customers that validate what you're doing. Then you've got A, B, and I don't know, you know, there used to just be A, B, C, and then they call it mezzanine or go public. But today's world, it's a little different. So your scaling is you've got a team, you've got a revenue model, you got customers, and an investor can see how they're going to grow. You know, it's like, oh, I get it. So a lot of times at this stage, you may go out and get, let's say, one big customer that's paying you, and that could be validation. There's other companies, like if you go to an Uber or something like that, at this stage, they go get one city. They'll say, okay, we're going to go to, you know, Denver. We're going to set up our model, see if it works. If it works, then we'll figure things out, like how many salespeople do we need? What does that model look like if we move it to Reno, or we move it to Las Vegas or San Francisco? So that's kind of what you focus on there, is get a model, figure out who your customers are, get one or two, and then show that it works. There's a lot of companies. I've done medical device companies are big in the go-to-market area, because a medical device company to go public nationally is about $100 million. So what they'll do is they'll start in one territory, get one city or something. They'll get that to work. They'll get the doctors to use whatever their device is. And then they'll go back and say, okay, look, we got X percent of this market. Here's how it works. Now we need to raise that $100 million. I've got a client right now. We got to this point, couldn't get to that point. So they got FDA approval. They've got a product that works. They've also got a product that costs too much, and you'll probably never see it. But it's a really cool product. It just doesn't work well enough, and it can't scale. So the investors basically put it on the shelf. This is one of my wind down deals where I'm actually the CEO. I have no idea how the thing works. I just kind of keep track of the checking account. The investors, they're all scrambling around. They've got $70 million into this company. And they're all scrambling around trying to find a new use for it. But they have FDA approval, which is too bad. And there's quite a few medical devices like that, unfortunately. We laugh quite a bit. You can have a cure for cancer and can't raise money, but you can come up with another social networking software and raise money just by walking down the street. So the world's not always just, as we all know.
If you have a cure for cancer and you can't raise money, you're not telling the story right.
Well, that may be the case, but I've seen a lot of cures that die. Well, okay, side note. So, yeah, the medical world,
choice matters.
it's really, yeah, because it takes money for some of this stuff to get out there. And then the investors just don't make enough. So they roll up their sleeves and put it on the shelf. It's too bad. This one product that I told you about is for obesity. And the competitive product, it's twice as good as any competitive product. And, but because of the market price and stuff, nobody will buy it. So they just put it on the shelf. Because obesity and diabetes now are huge markets just because of the volume of people in there. And so, you know, people will go back. Oh, I got another one for you. This is another company that's struggling. They have a physical device that some professors at Stanford have proven that anxiety is not mental as much as it's physical. And what happens is people get nervous and they breathe differently, which leads to different mixes of oxygen and stuff in your blood system. And so people get nervous and anxious. These people have a little device that basically teaches you how to breathe. You spend 6 weeks with this thing, 20 minutes a day, and you go from not being able to look at an airplane to flying it. And they have clinical studies, it works. Great product. Zero market. So the CEO, who's a good friend of mine, she went to the head shrink at Kaiser and said, hey, look, we got this device. Works really well. Here's all our clinical studies. How much does it cost? He looked at it and he said, well, you know, I could just keep issuing pills at half the price. Yep. So I'm just going to keep issuing pills and we're not going to bother with it. So don't get me started on medical devices.
Wow.
So anyway, and then the B and C is just where you really got to take off. This is where you've got to prove that you can get to $1 billion in 5 years, 4 years, depending on the market. But that's the ones where you really got to get rolling. Let's see. Buy money, you're not selling equity. So it's pretty straightforward. You're basically, you know, your investors are buying your equity, you're trying to buy their money, however you want to put it. Especially at the early stage, everybody reads books about Bill Gates and Larry Ellison and, you know, Elon Musk and stuff like that. And they all say, I want to own 50, 60% of my company. I just listed off all the people and the thousands and thousands of people that have actually pulled that off. So if you can pull it off, great. But if you want to get your business started, just if you got an investor, you got a decent attorney, get reasonable terms and take the money. I've had plenty of CEOs and investors tell me, look, you can't raise too much money. There's no, you know, yeah, money can be really expensive, but at the same time, if you need it, you kind of just got to take it. I've got a list a mile long of companies that thought they were worth more than they were worth. Because, you know, out of all the books, because people will ask us, well, how do I calculate what my value is? Well, I don't know. Well, you're the finance guy. Well, I don't know. It's like, what will somebody give you for it? So there's all sorts of nice math. But reality is, what's somebody going to give you? If they're not going to give it to you, you can do all the calculations in the world, and it doesn't mean anything. So take your money, make sure it's reasonable. You don't want to do something stupid with it, but take it. Equity is a substitute for cash comp. This is just kind of a formula that gets you to think about what your time and your money's worth. So a lot of times when you start a company, people come and say, look, I've loaned the company $100,000 or whatever. And I want to get that back from the investors. It never happens. Investors, you loan them $100,000, the investors might give you 25, 30% of it back in cash, and the rest they're going to roll over into equity. Because investors don't like to, as I put it, pay for past sins. So, you know, if you've got a big stack of debt on your balance sheet when you go to raise money, you're probably going to scare investors away. So stay away from the debt. If it's your personal debt, Well, you're gonna get some money, but don't expect the whole thing, because that rarely ever happens. Now, I sum that all up by saying be stingy. In my world, at least, a lot of times what we'll see is we'll go into a startup and talk to them in an early stage, and there's guys that will want to pay for our services, and there's guys that will want to give us equity. The companies that want to give us equity usually aren't going very far. It's kind of back to the guys with the Ferraris and Porsches up, posters up. So be pretty stingy. Get some help for equity, and that's fine, but don't give it to every Tom, Dick, and Harry that walks in the door. And then the other side of that is obviously take as much money as you can get, but don't be stupid. But again, there's no formula. And then the last point here on valuation, it's kind of your valuation usually, your mind's valuation usually doesn't count as much as what somebody wants to give you. And the best way to negotiate with anybody on all this stuff is get multiple investors so they start a little bit of a bidding war. And usually early on, you get one or two investors, you're happy. It's like, great, I can get started, I can pay some people, and that's fine. But again, go back to those milestones we talked about earlier. If you only need $100,000 to get to one of those milestones, take 110, don't take 2 million. So kind of plan it there and be wise about it. Okay, other sources of capital. The Kickstarter and those things, I've seen quite a few companies get started with those. I've seen a few get in trouble because you feel really bad if you do those things and you never deliver a product. So that's always, we kind of get our, we get an earful every once in a while when we got to tell a guy, well, that $1 million you raised on Kickstarter, you never delivered a product. Oh man, I really feel bad. I go, well, not much you can do about it unless you're independently wealthy. So that's a good program if you're pretty comfortable you're going to get to a product. Prepayments is always a good thing. Back to the earlier slide, if you got somebody that wants to try your product, get them to pay you up front. Most people understand with a startup that, okay, there's a risk involved here, and try as best you can to get money up front. Suppliers, you can ask for generous terms. Yeah, you're probably not going to get too many. Silicon Valley, maybe a little bit different because everybody's used to working with startup companies. So they'll take a flyer on a company hoping that they take off. So doesn't hurt to ask. A lot of guys will come back and hitch up later, but at least you can ask. You may get some pretty decent terms to get started, but you're gonna pay for it at some point. And then lenders, asset, lease loans, venture debt. Those are all different ways of getting stuff financed. The receivable inventory financing becomes a little dicey, only because we're getting paid up front. There's not much to finance. Assets, leases, and loans. If you can, nobody needs a copy machine anymore, so it's not like you need a $1,000 a month Xerox machine, but there's other things. We rent, furniture, things like that. Just be creative with that stuff as best you can. Venture debt you usually need after you've got an investor. Yeah.
What about revenue sharing?
Yeah. That's kind of on the customer side, right? Yeah. So if you can get a partner, just be careful with partnership agreements because you can sometimes give away too much.
Right.
And then you're in trouble.
Signing up with them.
Well, yeah, Amazon's kind of a drug of its own kind, but yeah, usually Amazon's pretty decent at the low levels. Plus, it's so inexpensive. They're not too bad. Now they will collect, which is, you have a pretty good story. So, yeah, what do we have here? Go back to slide 7 on the equity. Just be careful what that is. There's another thing with equity, especially with customers. Equity in customers creates a whole mess from an accounting standpoint. So if you start giving away equity, so you have a customer that could become a huge customer down the road, you give them equity in the beginning, you're doing, you're spending tons of money the rest of your life paying for some accounting calculation that figures out some intrinsic value of that equity and discounts your revenue and everything else. So try not to give equity to customers if you can help it. Or if you do, make sure it's a real clean, kind of one-time deal and doesn't affect the future. All right. Let's see. So now you've got to the point where you've got some investors, and here's all the things that can go wrong there. Inaccurate cap table. And this is a big one. Don't promise percentages. Does anybody know what I'm talking about? Oh, good. There's a few nodding heads. I don't know why, but it wouldn't be the first time that I get a PhD from MIT that started a company, and they go, what's your cap table look like? Well, I've got this, and then I gave Joe 5%, and I gave Mary 2%, and then I go, 5% of what? Well, what do you mean? Well, you gotta have a pie to give a guy 5% of the pie. You go, oh, I never thought about that. So don't promise percentages. Work with your attorney to understand exactly what there is, because depending on the point in time, I can make that 5% become almost any number you want. And ultimately, you're giving people shares of stock, not percentages of the company. So be really careful with that, because it's a mess. I just had one last month where the guy gave some guy literally 5%, and he got funded. He got 5 million with another 45 coming in. He gave the guy 5%. And so it was like, did you give him 5% before the funding? Did you give him 5% after the 5 million? Or did you give him 5% after the 50 million's in? I don't know, I didn't think about that. Well, probably ought to think about it, because it's a lot of the company. So we had to go mud wrestle with some guy, figured it out, but it wasn't what the CEO wanted, and it wasn't what the other guy wanted. We've talked about this, employee agreements, all the documentation. Make sure that stuff's cleaned up, because investors want to know where the risk is. And again, as far as you as a CEO are personally liable for the payroll taxes, the investors are liable for payroll and things like that. So, the last thing an investor wants to find out is he's got to go pay a bunch of money that he didn't know about, because the documentation and stuff is messed up. If you get a payroll service, they'll usually take care of all the tax ID numbers and stuff. So that's another reason, ADP costs you like $75 a payroll, and they do all that stuff. You can have 2 people on the payroll. It's just $75 is really well spent. And financial statements. I talked earlier about accrual financial statements, and I'm not really talking about that. Here I'm talking about how much money you have in the bank, especially at the early stage. So how much money do you have in the bank? Who do you owe money to? And then that's really what they want to know, because they don't want a surprise. And again, I've had it happen where you show up to the first board meeting and the CEO drops the $100,000 bomb on the investors, I put together the financial statement, there's $100,000 debt. The investors go, what's that for? He didn't tell you? No. He's the CEO. He loaned the company $100,000. I told him to tell you he wanted the money back. And then we have an interesting conversation. So yeah, just make sure you're real clear about what your financial status is. Don't worry about accrual books and stuff. Just explain exactly what you have. Let's see here. Oh, bad pitch deck. So, contrary to popular belief, let's keep this really simple. Anything over 20 pages, you're going to get thrown out of the room. You put all the team and stuff up front, you're going to get thrown out of the room. You basically want to say, here's what we're making. Here's how big the market is. Here's who some of the competition is. And here's why we think we can beat those guys. And oh, by the way, I got Bob and Mary and Sue and whoever as my engineers, and they actually know what they're doing. So keep it short. And the other thing is listen to the advisors. I mean, we see this all the time. It's people come in and, well, that's what you think, but I like my pitch deck. Usually if somebody doesn't like your pitch deck, it sucks. So pay attention to them. Plus, they're the guys giving you the money. You know, again, if they want that blue thing red, hey, we're painting it red tomorrow, as long as the money comes in. So pay attention to that stuff. Usually investors have egos. They don't want to be told they're wrong. So by default, that means you're wrong. So listen to them. And then hit the attorney thing again. Get good attorneys. You can get them for free. Again, if you're a technology company, just go look up a list of attorneys in Silicon Valley and call them up. Call me up, I can point you to a bunch of them. But don't just use some guy in, Kansas City, because he's a buddy of a buddy of a buddy's. Because I tell people all the time, we get a lot of business plans. People are always throwing plans at us, thinking that we get them funded. And the first thing we do is take them out to the attorneys. We run their plans by the attorneys we know. And if the attorneys like it, then we go, hey, go sign up with Mary over there at Wilson Sonsini, because she knows a couple of investors. Because most of the attorneys work in industries, and if they're half decent or better attorneys, they work with all the investors in that particular industry. So they'll know who's interested. And the one thing, the venture folks are not, they're kind of hard guys to sell to, because they're venture guys. They get a gazillion dollars and they don't need to, push their stuff, but they always appreciate people that send them business plans, even if they're garbage. We send them out all the time and they just come back, hey, not interested, or we're interested, or whatever. And the attorneys do that also. So they're very tight. Most of the attorneys do the legal work for the venture funds. So they kind of, I don't know what the Chinese wall is between them, but I figured I'd never try and snoop around. I'd probably get in trouble. So, yeah. My last bullet there, believe it or not, that's the key to getting funded. I can tell you by your attorney if you're going to be successful or not, usually. All right, what else we have? Oh, then we got an ad. An ad, we're done. Okay, any questions?
Yeah. Your signaling is like, don't take the money, have an attorney, they won't take money up front, they'll get you later. So, but be tight with your equity. So Do you have any rule of thumb on percentages or?
Percentages of
How
what?
much you give away of your company?
So a typical venture, Series A, will want 20%, 20 to 30%. And they kind of figure they're going to stay at that range for at least a couple rounds. So if you're going for a Series A, that's kind of the typical number. Now there's a new deal out called safes, and I forget what they're called. But there used to be convertible debt, where a guy gave you $100,000, you discount the next round, and then he can convert that into equity. Now they do these safe things. It has a couple different little triggers on it. But
Only California though, really,
well, the safes are only in California.
for the most part.
No,
They're
that's
very
through-
comfortable.
That's through, what's that, Y Combinator.
Yeah.
The Y Combinator has popularized them in California, but outside of California, they're not. They're sort of frowned upon.
Yeah, but I'm seeing it more and more. Yeah, a friend of mine at ORC, a guy named John Batista, he and his partners came up with those things. And yeah, Y Combinator uses them all the time.
Yeah, they kind of.
Yeah, yeah. I'm trying to get John to explain it to me. Yeah, and that's why, because I think you're right. If it's not if you're not dealing with the Silicon Valley, and what an attorney once told me, in Silicon Valley, venture capitalists have a way of making lemmings look like individuals, because they all go in the same direction. They all, if somebody at Sequoia jumps on something, somebody at Sierra or one of the other funds wants to jump in the same industry, and they're all very competitive. So you're right. When they value a company, they may look at a particular company and say, okay, Series A is going to be 10 million pre-money. Doesn't matter what you have, they're going to lock it in. But there is no formula. It's just kind of where they come up with the number. And they all know what each other does, which is, there's nothing more confident, nothing less confidential than a board meeting with a bunch of venture capitalists, as you probably well know, right? It's like, here we go again. Don't say anything, and then you go to another board meeting and they're talking about it somewhere else. But yeah, you do have to understand who your potential investors are. And yeah, they're not all going to be venture companies. So you got to pay attention. All right.
Other questions?
Yeah.
Could you talk a little bit about, because you were talking about the venture, so the pre-seed, or pre-seed, or after you get the, your friends, family, full money. Do you know much like that? What about the angel market? Like where would you go to find angel investors or those?
So we get asked all the time about angel investors. And reality is angel investors are typically rich people that have a particular interest in whatever your product is. So there are angel forums and Keiretsu Group and all that pull angel investors together. But if you don't go through one of those, you're typically finding somebody that just has a particular interest. Like the one company I was talking about with the anxiety, it's funded by a retired partner out of a venture fund whose wife is a PhD at Stanford. I worked on him on all software companies, and all of a sudden he shows up investing in this medical device company. Well, his wife discovered it at Stanford, so where else would you go except for hubby to go get a couple $1 million to get started? So angel investors are really difficult, unless you go to like Keiretsu Forum and those types of things, where you can present to a big group of people. But even in that group of people, the people that are going to invest are the ones that have a personal interest in whatever your product is. There may be a family member or something that does something and, or has a sickness, or, kids in the software industry. It's really hard to.
Yeah, that seems to be the crux. I mean, getting to the once you're at the level of even approaching, the venture capitals, you've already got all the things you're talking about, whole payroll,
Yeah.
HR and all that. But for the startups, you're not even hiring a staff.
Yeah.
So you kind of have to break past that point of bootstrapping and angel investing to get to that.
Yeah, we see angel investors, it's like, what's that guy doing in that company? And then it ends up, it's like, some family members got an interest, or it's the guy's hobby or something. Yeah, so it's tough. Any other questions? Oh, I hope I was worth the, $6 if lunch was happening.
12.
Oh, they had to pay for lunch, right?
Lunch costs more than $6. That's why we.
Okay, $4. All right.
Thank you,
Well, thank
Dan.
you.
Thank you. Okay, as Grace mentioned, next Wednesday in this room at noon, there is a finance panel, and it's going to be moderated by Grace. And the speakers will be Rick Winfield from the Reno Seed Fund, Jeff Sailing from Startup NV, Ellen Purpose, and she's with UNR. What is her exact title, Grace?
She's the Assistant Vice President for Enterprise and Innovation. So Nevada just won an award on helping technology company here to apply for SBIR. So if you're a technology company looking to potentially apply for SBIR,
And SBIR is non-dilutive. So there's a couple rounds that you can go through. So the first round is about $50,000. It's non-dilutive. You're not giving anything up. And then if you're able to establish customers with that amount, then you can apply for more.
So there's just one more thing. So if you want to 50,000, so it's really depending on the granting agency. All federal research agencies, DOE, NIH, DOD, they all have to allocate certain funds for SBIR. Really is non-dilutive, so it's a grant, so you don't have to
Joe Amato, who is the head of the SBA, he's down in Vegas, but he's the head of the SBA for Nevada, will be up here. Chris Reach, who is one of our local founders, he's had an exit. He has another company now, Fox Automation, and he's working with that one. And what's the name of the new person that you've gotten?
we also have Jeff Olden from US Bank, so he's a lender, does a lot of SBA loans. But the important thing here is that you have a panel of people who actually make investment, whether they're a lender or a venture capital. The Reno Seed Fund is a seed fund, so they invest in early stage companies. And you also have a couple entrepreneurs that can talk about their finances.
Yeah, so you're going to have quite the gamut, the whole A to Z on different sort of financing solutions. So the cost is $5, and we'll have drinks and some snacks, but no sandwiches, because that costs more than $6. So thank you all for coming today. Feel free to mingle for another almost an hour. I think we have the room until about 12:45 or 1:45.